Earnings season is wrapping up with more than 90% of S&P 500 companies already reporting first quarter results. Nearly 80% are beating earnings estimates and 60% beating on revenue. Ben, what's your take on earnings so far?
Well, we came into earnings season, and I think people were kind of feeling down about it, but the numbers have been good. Revenue is up, or at least pacing for a 3.7% increase, and earnings are pacing for 7.4%. We're also seeing better revisions than we normally get during a quarter, which means that we're actually looking at higher earnings, not much higher, but higher earnings for the year than we did going into earnings season. And that's all pretty good in terms of how corporate America is doing.
Over the longer term, stocks follow earnings, so this is good. But you noticed an interesting dynamic, which is that those companies that are beating, they might bump up a little bit. But if you didn't beat, look out.
Yeah, I mean, we always see this there where companies get punished more for missing than they get rewarded for beating. It's just a normal thing. But this quarter, it's actually worse than normal. So we're seeing stocks that actually beat on both earnings and sales are up only 0.7%. That's less than normal. And stocks that miss on both are down 4.2%, which is actually worse than normal. And we're not necessarily seeing that, but we're seeing a lot of idiosyncratic kind of moves in companies, even in the same sector. So earlier this earnings season, we saw the day where Meta reported it dropped 11%, but Alphabet, when it beat, it went up 10%. And this week we saw in the ride-sharing companies, Uber dropped about 6%, but Lyft gained 7%. And it's just, it depends on what's going on with each specific company.
Jack, one stock that got absolutely creamed the week before last was Starbucks. Get a cream, Starbucks. What was going on there?
Nice work, Jack. It's an extreme case, plunged 16% in a day to start this month. Same-store sales, they were positive 5% the quarter before. They collapsed to a negative 4%. And B of A says it hasn't really seen a reversal like that since going back to Chipotle and that E. coli outbreak years ago. So it issued a report this week trying to solve the Scooby-Doo mystery of what's going wrong at Starbucks. It says it's not the economy because there's not really signs that customers are trading down or buying fewer items. It's blaming a social media boycott linked to Israel and Gaza. B of A calls it a buying opportunity. I spoke with the analyst at William Blair. She says there's still way too many questions about Starbucks. She downgraded the stock. I kind of wonder if it's all those Dunkin' Donut remodelings that has people going to Dunkin' instead of Starbucks. We'll see.
But for now, righties should drink Starbucks, lefties should drink Bud Light.
I've lost track of how it works, but thank you.
Okay. So, Ben, amongst the rubble, any bargains?
Well, I saw two that kind of stood out. One is called Builders First Source. They sell goods for people who are building houses. And they dropped 19% after releasing, even though the earnings were
19,
fine.
not 90.
19, yes.
Okay, good.
19%. And the bulls are saying, look, that the concerns about margins and guidance and even about share repurchases are just overblown, and that this is a great opportunity for investors who missed this big rally the stock has had. It was up 80% over the past 12 months heading into earnings. The other is Shopify. It also dropped 19%, not 90. And bulls say not to worry about margins, that the company is going to spend more, but it also is raising subscription prices later in the year, and there's a lot of potential for market gains. And so both of those could be interesting.
All right, Elizabeth, next week we see some retailers reporting earnings. Jason Furman says the consumer is holding up kind of strong. Is that what you're seeing?
Well, we'll see. We'll see what the data bears out next week because we've got two big reports coming. We have the Census Bureau's retail sales, monthly retail sales, and we have the New York Fed's quarterly household debt and credit report. So, well, we'll see what the numbers say. Yeah.
Okay, so who are you looking for in terms of stock reports?
Well, next up we have Walmart, is coming up next week. And, Walmart, of course, benefits from the bargain-conscious consumer. They tend to do well when there's tightening. The week following we have Target, and they, of course, they're seen as more of a splurge-worthy items, more discretionary spending. So they tend to not do quite as well with a bargain-conscious consumer, but they can benefit from low expectations. The stock can benefit from low expectations.
Target, that's where the fancy people shop. Yeah.
Love Target.
Ben, any other stocks that we ought to be keeping an eye on?
Well, I think we get Home Depot next week.
Okay.
I mean, this is the big week for retail, so they're another one that I'll be watching just to see. Again, if they're like Builders First Source, maybe they get hit, but they are selling to different kind of consumer. But they're always one to watch just for a read on retail plus on the housing market. So I think that's another good one to watch.
Yeah, people they don't want to get out of their house and they want to keep that mortgage, so they just renovate. All right, thanks, guys.